3 of accounting 260. So we're going to continue with posting to the general ledger. We're going to go a little bit further by talking about preparing an unadjusted trial balance. Okay, so let's get started. This is Chapter 3 of the Accounting Information Process. Our learning objectives today are review important concepts, review posting to the general ledger, talk about preparing an unadjusted trial balance. This is the first time we're presenting this. And then demonstrate the entire process for using an opening trial balance, do posting to the general ledger, and finally preparing an unadjusted trial balance. We're going to do all that. First thing, an account is an individual accounting record of increases and decreases in a specific asset, stock, loss, equity, or expense items. As you know, these are elements. So each one of the elements as we've seen, that make more specific what the element is. So a T account is simply a line with the title of the account on it, and a left side and a right side of if debits are greater than pretend this is the cash. The cash account is an asset account. All asset accounts are on the left side of the accounting equation. All other normal balance. So let's say we increased cash by $10,000. And 2, we decreased cash by remember, everything on the left side increased to decrease. So we increased it by 10,000 in transaction 1. In transaction 2, we decreased it by 3,000. And then in transaction 3, we increased it again by 8,000. So the debits are 10,000 plus 8,000 is 18,000. The credits are 3,000. So the difference let's pretend this is the accounts payable account. Accounts payable account is a liability account. Liability on the right side accounting. So that means we credit to increase a liability. We to decrease the liability. Decrease account payable with the first transaction because we added it. The second transaction increased accounts payable because we credited it. And the third we credited it. The total credits are 10,000. Difference makes up the account. We do not post directly to accounting. Element has accounts underneath it that are specific to those elements. The asset accounts are defined by being resources used and owned by the business. Well, there's equipment that's used and owned. There's land that could be used and owned by the business. Be used in business. could be cash that could be owned and used by the business. We break that down, all the types of assets. One of these is a separate account where we that specific asset or expense. Liabilities also have their own account. For instance, an accounting element, liability, has interest payable, which might be interest we have to pay on a loan to an outside party. Salaries and wages, the amounts we owe to employees. Again, employees are outside the company. Accounts payable is amounts we owe to suppliers. We owe to the bank, or different types of liability accounts. Stocks are retained earnings and common stock. So keep in mind the following characteristics about the accounting elements of the accounting equation. The accounting elements are all fit. When we refer to the accounting elements, we are referring to the total amount of all assets, all liabilities, and all stuff. Total value of each account may be increased or decreased as needed. So assets are increased. Liabilities and stockholders' equity are increased by a credit. Element, this could have cash that would be an asset, and that's valued at $10,000. We could have inventory that's an asset, and that could be valued at $40,000. And we could have machinery that's an asset, which is valued at $50,000. So the entire element added up. A specific asset has its own activity, records its own activity, and has its own balance. Inventory has a balance of 40,000, and machinery has a balance of 1,000. Examples of how the total value of an accounting element increase or decrease. So let's say we have the assets, which are debit to increase and credit to decrease. So the value of all is 10,000, the value of all inventory is 40, and the value of all machinery is 50. Let's say we exchange, we give up $5,000 in cash for more inventory. Well, that means that our inventory went up 5,000, and our cash went down 5,000. So cash equals 5,000. $5,000, and machinery stay the same. Let's say that we exchange for another way of looking at that. Concept is in accounting, we use the term debit other direction, increase or decrease in a specific accounting element. The word debit simply means left side. Right. So the accounting equation Everything on the left side of the accounting equation, that would be assets in the basic accounting equation. So everything on the left equal sign, left of the equal sign, and credit to decrease. Liabilities and stockholders' equity are on the equation. Here's the equal sign, and here's liabilities and stockholders' equity. It's on the right side of the equal sign. Everything on the right side of the equal sign is credit to increase and debit to decrease. It just adds expenses and revenues. So on the left side of the accounting equation is debit to increase and credit to decrease. The difference is we've added expenses to that. So now the equation are debit to increase, credit to decrease. We've also revenues to the right side of the accounting equation. Everything on the right side of the equal sign is credit to increase and debit to decrease. The act of recording an accounting transaction is referred to as journalizing, or to journalize. The entity affects the transaction in a journal. The journal can be called the general journal. That's the first journal we look at, is what one of those looks like in a couple of seconds. So we have the steps of recording accounting transactions. First is decide if the event transaction. Two, if it does qualify as a transaction, identify the what you received. Remember, every exchange of resources. I give up something and I get something in return. So start with the what we receive side, what we get. Classify the what you receive side into the appropriate assets, liabilities, stockholders' equity, revenues, or expenses. The side accounting element identified in step 3 above increased or decreased. And that will determine whether or not, and then the fifth step is use the debit and credit rule, decide if you need a or credit based on your decision. So let's go through this a little bit. So, and assets can increase. I mean, we use a debit. Step 4, an asset decrease, or it's an asset decrease, we use a credit. So specific account increase asset and increase debit. An asset decrease, we use a credit. We have an expense. And it increased debit. If we have an expense and it decreased, we use a credit. We use a credit. Liability decrease. We use a debit. The equity item. And at least we have a credit. If we have a stockholders' equity item, we use a debit. If we have a revenue item and it increased, we have a credit. If we have a revenue item, use debit. If the event qualifies, that means that it is an exchange of economic resources and it can be valued in economic terms. If step one is yes, it's a transaction, then you identify the what you receive side of the transaction. Remember, all transactions are exchanges. You give up something and you get something in return. Classify what you receive side into the appropriate accounting element, whether it's a revenue, asset, liability. Decide if it went up or down, what we just showed you. On what you gave up side of the transaction. Remember, every transaction received and what you gave up. Classify the what you gave up side, the appropriate accounting element or account. Decide accounting element, the debt number 7 up, decrease. Then again, use the accounting debit credit rule. Each transaction credit. Equality of debits and credits is the basis of double entry accounting. Debits must equal credits. Asset account increase for debit and decrease for credit. Increase life to increase. So it's recorded. And equation, everything right the accounting equation is credit to increase. So that means the stock, all stockholder equity accounts are credit to increase. That includes common stock and retained earnings. Revenues are on the right hand. Therefore, everything on the right side of the accounting equation is credit to increase and debit to decrease. So therefore, revenues are credit to increase and debit to decrease. Expenses are on the left side of the accounting equation. Everything on the left side of the accounting equation is debit to increase, credit to decrease. So therefore, expenses are debit to increase and credit to decrease. Recorded in chronological order internally are transferred to the accounts. This is called transaction in a journal. They are transferred to the accounts. This is what's referred to as posting to the general ledger. The journal contributes to the recording process because it discloses the complete effect of a transaction, provides a chronological record of transactions, helps prevent or eliminate errors because the debits and credits can be readily compared. Analysis of any transaction data in a journal. Recording a transaction journal. Transaction is recorded into a general journal. That's one type of journal. So we take a transaction, record it into a general journal. A general journal looks like this. So we have the date, the first October 2nd. We have the debit account, which goes first, the credit account, which goes second. Debit account, credit explanation. Posting to the general ledger. So now we're in here. We're going to go to a general ledger. Posting involves 3 steps. In the ledger and the column of the debit account, the date and amount of debit amount shown in the journal. In the ledger, enter the appropriate column in the credit account, the date and the credit amount shown in the journal. Smith Company is good for resale from from Jones Company. So the first step is entry in the general journal. So we received inventory as an asset. All assets side of the accounting equation. That we have for resale, the amount of inventory increased. Every accounting equation is debited to increase. So we debit inventory by 30,000. Cash and asset. Cash is on the left side of the accounting equation. Cash went down because we have to pay cash. Everything on the left side of the accounting equation is debit to increase and credit to decrease. So we credited cash, increase in an account, then accounting asset, debit. As you know, everything on the left side of the accounting equation, meaning to the left of the equal sign, is debit to increase and credit to decrease. Decrease in the account within the accounting element of assets by credit. Everything on the left side of the accounting equation, meaning to the left of the okay, from there, first we journal entry, and then we posted the journal. It's the same thing you saw here. I just posted. So what you do is you count general ledger account, which is right here, says general ledger account inventory, and you debit it for $30,000. So you go to the general ledger account, which is a listing of all your accounts and all in the account. Inventory. You increase it by 30,000. That's what it means. And then and you use the term cash here and credit cash reduction. Same thing here. We debited it. Prepare an unadjusted nature of a trial balance. A trial balance is a list of accounts and their balances at a specific time and at a specific time. Accounts are listed in the order in which they appear in the ledger: assets, liabilities, stock goes, equities, revenues, and expenses. Purpose is it may uncover errors in journalizing and posting, useful in the preparation of financial statements. So that's what trial balance is like. Of the balance time. We're going to actually go through and prepare one of these in a couple of seconds. Limitations of a trial balance. The trial balance may balance even when a transaction is not utilized. A entry is not posted. A journal entry is posted twice. Accounts are used in journalizing or posting, or offsetting errors are made recording the amount of the transaction. Learning Objective 4, demonstration of the entire process. Now we're going to go and share Word, where I'm going to actually go through this entire process. opening trial. So what we have is an opening trial balance, means these are the opening balances for this as of January 1st. So this is the beginning balances of the company. So the first account that we're going to post is cash. $1,000. So go to account cash. And put $50,000. Now I'm going to just draw a line because that's just makes me comfortable. You don't need to do that. Because and what I'm doing is I'm going to each account, the amount from the trial balance into the account. That's the first step. So accounts receivable is $200,000. Account is just the transaction. So I put the $200,000. That's true. $150,000. Accounts payable. Notice that these have debit balances. These are all assets, which are resources owned by the business. Out of the accounting equation. Everything on the left side of the accounting equation has a debit increase. These have a natural left of a debit, a normal balance of a debit. These are all on the right side of the accounting equation. You create the right side of the accounting equation with a credit. So these all have credit balances. Okay, so you notice a couple of things here. First, we skip some of the accounts. If account is not listed here, so for example, we have a bank called computer. We also revenue. We didn't put anything in there. We have salary wages. We didn't put it in there. So we only go to the accounts that have balances here. Also, as you know, debit and credit balance. For example, I'm just $1,000. I know that's and assets are on the left side of the accounting equation. And assets are increased by debit, so their normal balance is increased by a debit. So their normal balance is 50,000. Accounts receivable. Accounts receivable is an asset. All assets are on the left side of the accounting equation. All assets are debited to increase, so they have a normal balance of a debit and a debt. Inventory, same thing. Inventory is a debit. All assets are on the left side of the accounting equation, so I know that's a debit. Payable to liability. Liabilities are on the right side of the accounting equation, so I know that's a credit. Stockholders retained earnings is a stockholders equity account. Stockholders account right side of the accounting equation, so I know that's a credit. Common stock, again, stockholders equity accounts are on the right side of the accounting equation. Some transactions. The first one, Smith Corporation purchased goods for resale. $5,000. Smith promised to pay Frank in what did Smith got him for resale. Smith gave up. He promised to pay as an accounts payable. When you promise to pay your vendors and your suppliers, that's an accounts payable. So inventory is an asset. Equation, the amount of goods I have for resale now went up $5,000 because I increased it by $5,000. I have a promise to pay Frank Corporation. My promise to pay went up by $5,000 because now I have an additional amount that I owe Frank, which is where accounts payables or liabilities. Liabilities are on the right side of the equation. Went up. So therefore, I need to credit because liabilities are increased by a credit. Everything on the right side of the accounting. So from there, I go to this specific account. One. And I $1,000 because I did it in the journal entry. I debit. So I debit inventory. The other side of the entry is the credit. Accounts payable. Payable is a liability. I increase the liability by hand. So I go to the liability account. Do the same thing that the journal entry did. And $1,000 in second. Smith Corporation sold services to Mr. Jones, charged Mr. Jones 20 grand. Mr. Jones promised to pay for the services in 30 days. So my customer has promised to pay me. That's a resource. That's a resource used and owned by the business. All resources used and owned by the business are the amount of receivable from customer. All assets are on the left side of the accounting equation. The customer went up with this. Mr. Jones now owes me $20,000. He didn't owe me before, so that went up. on the left side of the account equation is debited to increase and credited to decrease. What I do for the money, why does Mr. Jones owe me? Because I provided him with services. Services accounting equation. Revenues went because I didn't have four. And everything on the right of the accounting equation was credit increase and debit decrease. So to the general ledger accounts. And post just like the same information that was in the journal. And I go to the revenue account. It was on the right side of the accounting equation and it increased. I need to credit revenue. Now that journal entry is posted. Well, work for me are providing services that I need for our cost of doing business. Expenses went up because now I pay my, or I didn't have. What cash? On the left side of the accounting equation, the left side of the accounting. That decreased the amount in my bank account. The increase in an asset is a credit. Exactly what's on the in the journal. And now I bring down the balance. I have 8,000 in credit, so I subtract 8,000, get 2,000. Smith Corporation received payment from its customers, so a customer owes them money and pay, as we said earlier, when a customer owes you money, that's an accounts receivable. That's a resource owned and used by the business. And customer doesn't owe us since they paid us. They don't owe us the 8,000 anymore because they paid us the 8,000. Accounts receivable, as we said, is an asset. Assets are on the left side of the accounting equation. And we decrease everything on the left side of the equation by using credit. What did they pay us with? They paid us with cash. So we took put it deposit in our checking account. That increased the amount of cash asset left side of the accounting equation. Everything on the left side of the accounting equation is debit increase. So we go down to the cash account and we make an entry for debiting cash for $8,000. And we go down, the balance is the 50, plus 8 is 58, minus 8 gives me the 50. Receivable, $8,000 reduction, credit it, and it goes down to $112,000. So the corporation paid for office expense. They need office expense. They need office space to run their business, to do business type thing. Their business, they pay cash for it. So rent is cost of doing business. And the name is saying expense. Expenses are left on the side of the account. The amount of rent expense that I paid, that I incurred, has gone up $12,000. I did an expense for $12,000. I paid cash. I wrote him a check, which reduced the amount of cash I account. Set on the left equation. The asset named cash. Everything is debit to increase and credit to decrease. I go back up to the cash account. The balance now is $38,000. Entry additional $30,000. What happened? The stockholders gave $30,000 worth of cash business with a separate entity that cash. I got an additional check for $30,000 that my cash balance on the left side accounting equation is debited Give you ownership, common stock. Common stock is retained, is everything else is plus 30 is 88, minus Smith Corporation. And I need for my office, for my employees to do work. So you now it's utility, now things by increase or debit utilities expense. Pay them account. Cash is an asset. Assets are left in the equation. When I reduce an asset, it's a credit. Assets are debit to increase and credit to decrease. Entry number 8, Smith, Smith, they paid off, so that means they don't owe it anymore. Accounts payable is a liability. All liabilities are on the right side of the accounting equation. Anything on the right side of the accounting equation. Because we don't owe. We pay. Cash is an asset. We reduce assets accounting equation. You increase an asset by debit and decrease an asset by a credit. Smith Corporation purchased a new computer system for seven. So, got a new computer system. The computer system is a resource owned and used by. Smith got a new computer. Smith gave the company $7,000 in cash. Cash is an asset. Assets are on the left side of the accounting equation. Everything on the left side of the equation is credit decreasing my net cash. And that's a credit to decrease. Smith purchased for resale, but this time paid cash. Good. It's inventory. So I'm getting additional goods for resale. My inventory is an asset, a resource owned and used by the business. And assets are on the left side of the increase. I paid them in cash. Yeah. I Okay, so now that I'm done posting all the recording all the transactions in the general journal, this is what the general journal would look like. And I put them all to the general ledger. This is what the general ledger. I'm now going to prepare an unadjusted trial balance. An unadjusted trial balance is simply a list of all the accounts. So what is I take the balance, the ending balance, now that I've posted all the transactions, and I put it in the trial balance. Accounts receivable is 212. is 7,000. Note that the assets and all of these have normal all these belong on the right side of the calculation, and therefore they have a clear balance. 1,000. A balance of 80,000. Stock has a balance of 630,000. And has an account balance of 20,000. Here's $1,000. Then expense has a balance of and so this expense has a balance of 1,200. Now I take out my plus 112 plus 460 7 plus 12 plus 1,200. 1,000 something. 1,000. Now I do the credit side, 23,000, 8,000, plus 630,000, plus 10,000. And that's how you prepare an unadjusted trial balance. You can watch it on one. Now you know how to create a balance. Now, next step is that we're going to learn how to adjust it, make adjustments to it, and what adjustments are. Then we're going to prepare a adjusted trial balance, and then we'll prepare financial statements, and then our journal, and that's the end of the accounting process.